The Enron scandal was one of the most significant corporate scandals in American history, involving a complex web of fraud, deception, and corruption that ultimately led to the downfall of a once mighty energy company. Before we dive into the rest of our video, make sure you hit that subscribe button and turn on notifications, so you can stay up to date with all of our latest releases and never miss a beat. Enron was founded in 1985 as a merger between two natural gas companies, Houston Natural Gas and North. Under the leadership of CEO Kenneth Lay and later Jeffrey Skilling, Enron grew rapidly, expanding its operations into a range of energy-related businesses, including power generation, natural gas pipelines, and energy trading. Enron's success was fueled by its reputation for innovation and creativity, as well as its ability to leverage technology and financial instruments to manage risk and maximize profits. However, behind the scenes, Enron executives were engaged in a range of unethical and illegal activities that would ultimately bring the company crashing down. One of the key drivers of Enron's downfall was its complex accounting practices, which involved the use of off-balance sheet entities, such as special purpose entities, SPEs, to conceal debt and inflate profits. Enron executives created these SPEs and used them to transfer assets and liabilities off the company's balance sheet, which allowed Enron to report higher profits and lower debt levels than it actually had. These accounting practices were not only deceptive, but they also violated accounting rules and regulations. Enron's auditors, Arthur Andersen, were aware of these practices but failed to take appropriate action to stop them or to disclose them to investors. In addition to accounting fraud, Enron executives engaged in a range of other illegal activities, including insider trading, bribery, and obstruction of justice. Enron insiders sold millions of dollars worth of stock before the company's troubles were made public, and they also engaged in bribery and other corrupt activities in order to gain favorable treatment for Enron. The Enron scandal came to light in 2001, when Enron's stock price began to plummet and questions were raised about the company's accounting practices. In October of that year, Enron announced a loss of $618 million for the third quarter, which was a major blow to investor confidence. The company's stock continued to fall, and by November, it was trading at less than $1 per share. In December 2001, Enron filed for bankruptcy, which was the largest bankruptcy in American history at the time. The company's collapse had a ripple effect throughout the economy, affecting thousands of employees, investors, and other stakeholders. The aftermath of the Enron scandal was marked by a wave of investigations and legal actions, as regulators and law enforcement agencies sought to hold Enron executives and other parties accountable for their actions. In 2002, Congress passed the Sarbanes-Oxley Act, which aimed to improve corporate governance and accountability and to restore public trust in the financial markets. Several Enron executives were indicted and convicted for their roles in the scandal, including Skilling, Lay, and former CFO Andrew Fastow. Andersen was also indicted and convicted for obstruction of justice, which ultimately led to the dissolution of the company. The Enron scandal was a wake-up call for the business world, highlighting the need for greater transparency, accountability, and ethical behavior in corporate governance and financial reporting. While the fallout from the scandal was painful and far-reaching, it also spurred important reforms and changes that have helped to prevent similar scandals from occurring in the future.